Okay. Looks like we're going to be able to go live on YouTube. And one sec. Okay. Looks like we are live on YouTube. I'm going to broadcast here. We'll let our attendees jump on. So we have three people on here today. Mr. Martinez, there you are. We can hear you pretty clearly.
Yes, sir. I can hear you loud and clear.
Excellent, excellent. And Alan, can you hear us clearly?
Yep, I can hear you just fine. Thanks.
Great, great. All right. I like that bookcase behind you. Makes you look very astute.
Yeah.
Excellent, excellent. All right. So I just went live on YouTube on the People's Capital Group YouTube channel. I also went live on to our guests here, our participants. So everyone's jumping on here, and it's good to see our attendees jump on. Hopefully we have a good turnout today. We have a lot of interest, it seems, in how to self-direct your IRA, how to diversify out of that stock market, and just get into more tangible assets and learn more about that and how that works. So a lot of people have questions about it. And Alan, that's why I wanted to bring you on. You are the IRA specialist, and I'm sure you'll be able to introduce yourself and give a great presentation here. And what we're going to do for our attendees here today is we're going to have Alan speak for about 15 minutes about really, basically shopping around for the right IRA custodian, finding out what the right IRA custodian is for your needs and the price differences and the service differences. And Alan's been in this business. How many years, Alan?
In the self-directed space, about a little more than 5 years, but I've been in financial services for a lot longer than that.
Yeah, absolutely. So Alan's the IRA specialist that's going to talk more about self-directing your IRA and how to do that. And then Seth and I will present on the real estate end of it, how we work with those IRAs and move that into apartment buildings with value add strategies here in New Jersey. So Alan, you can share your screen. Is that correct? If you click on the bottom there, you should be able to share your screen.
Let's see, host disabled participant screen sharing.
There you go. I'll make you host. Now you should be able to.
Okay.
Screen.
What are you seeing? Oh, let's see. I want to. You seeing the title screen here?
Yep, I could see your presentation.
All right. Excellent. Great. And then with a little bit of luck, I'll be able to demonstrate a fee estimating tool here in a little bit. But first, I want to get into a little bit of background as to who I am, what I'm up to. I've just recently formed a company called SDIC Services, LLC. And here's a little bit of my background. Since you can probably see me on the video, you can see I look a little bit like that picture. Hair's a little bit longer. Still waiting for my clippers to show up in the mail. They've been sold out for months now, but I'm looking forward
to. Alan, I'm just on mute, but I am laughing over here. I'm in the same boat, my friend.
So I've been a business development manager for 2 IRA custodians, most recently with New Direction Trust Company. I left them here in April, this past April, and have since formed SDIC Services, LLC. Before being with New Direction Trust Company, I was with the Entrust Group, another self-directed IRA custodian. I had achieved a Certified IRA Services Professional, or CISP designation from the American Bankers Association in 2015. And before that, I was both an independent registered investment advisor as well as a rather short gig at Merrill Lynch. You see 2007 to 2008. 2008, as you all probably remember, at the end of that year, there was a big financial market crash. Merrill Lynch was acquired by Bank of America, and a lot of the newer hires, like myself, were invited to pursue other interests, which I did. So I want to talk a little bit, and it may be jumping the gun somewhat. I don't know how many of the attendees really are already familiar with self-directed IRAs. But I want to jump right in here and address some of the common myths. One of the reasons that I set up self-directed SDIC services is to provide a little bit more of some insight and kind of a joining together of what I see are disparate interests out there. When you look at the role of custodians, you look at the role of investment sponsors such as Aaron and Seth, and you look at the role of the IRA account holder themselves. And the IRA account holders, in my years in this business, there's some common myths and misunderstandings that they have. I'll go through these kind of quickly. They tend to think that self-directed IRA custodians, it's a commodity service offering, that they all provide the same services. That's not true. They think that there isn't really that much difference in the fees that are charged. You'll see in a little bit that there can be a wide difference in the fees. And they think that the custodians understand their investment. Also not true. The custodian really does not want to know much about the investment. They're only interested in the investment documents from the standpoint of seeing that they don't violate any of the IRS regulations that prohibit certain transactions. People also tend to think that the custodian, because they're taking control and signing and executing the documents, that they're going to monitor and manage the process of getting your IRA's investment in place. That's not really the case either. They really rely on the client to be the driving force behind getting this done, and they're ostensibly there in a passive role to do what the client tells them to do. And finally, clients tend to think that the custodian's primary allegiance is to them because, after all, they're paying the fees. I put here in red, like you, the custodian is afraid of the IRS. And what I mean by this is that the custodian is in the odd position of needing to report information to the IRS per IRS regulations. And some of that information needs to be provided by the client themselves. Clients tend to not really understand that. They don't understand the requirements that the custodian has to fulfill necessarily. They take their time, they're late, they don't respond. This can get the custodian in trouble with the IRS, and consequently, custodians will from time to time get a little bit, I'll just use the word pissy. I can't think of a better word right now. And clients oftentimes, it can cause some hard feelings. Why is all this confusion? Part of it is because the custodial landscape has really changed dramatically in the last few years. Currently, because I've collected them, there's more than 50 self-directed IRA custodians. I put self-directed in quotes because not all of the self-directed IRA custodians will hold all of the asset classes or asset types that the IRA account holder might be interested in investing in. But nonetheless, there's more than 50 of these and more than 75 different fee schedules out there to have to pick through. Yields on undirected cash in a custodian's IRA account are at historic lows. They don't really advertise the fact, but they don't deny it either. And if you look at all of the agreements that you sign off on, there's basically going to be some wording in there that says that the IRA custodian gets to collect whatever little dab of interest they can receive off of any undirected cash you leave in your account. When interest rates were in the high 5, 6, 7, 8% or higher, that was pretty lucrative for them. Now, much less so. They're also faced with challenges with new and unfamiliar investment opportunities, what I call the 3 C's: crowdfunding, crypto, and cannabis. Crowdfunding admittedly isn't all that new, but it still is a challenge for custodians to have to administer because typically crowdfunding investment sizes are quite low, and it makes it difficult for the account holder to be able to afford the types of fees that self-directed IRA custodians need to charge. There's differing technology being implemented out there, different platform capabilities. Some have online account opening, others rely on paper. Some custodians offer secure document exchange, others rely on email going back and forth, which is not a secure way of moving potentially confidential information back and forth. Some utilize DocuSign and allowing their clients to sign forms electronically. Others do not. They require you to print out the document, sign it in ink, scan it, and return it to them. So there's a lot of different ways that custodians can or cannot offer efficiencies, but the bottom line is those custodians that are trying to incorporate greater technology, there are costs involved in incorporating new technology. The margins are narrow because they're not getting the interest on undirected cash. And there's a resulting trend in what I'm going to refer to as cafeteria style services, but what a lot of IRA account holders refer to as nickel and diming. That all having been said, and before we get into some of the various components of what custodians may be charging, there's some basic do's and don'ts that we want to go over here real quickly. Do try to verify that the custodian will administer your investment before you open an account. And if possible, try to send a copy of the investment documentation to the custodian and ask them to review it and confirm that they'll hold the asset in your account before you actually go through the trouble and expense of opening an account with the custodian. Now, be aware of the fact that some custodians will actually charge a fee to review the document, because it's kind of like a guy coming out and giving you an estimate to do repairs on your house. Sometimes they'll require you to pay in advance, so that if they come out and they give you an estimate and you don't do business with them, well, they haven't wasted all of their time. They've gotten some little compensation for having taken a look at something and spent their time doing something that might not generate revenue for them. Do be thorough in completing all the required forms and documents that the custodian will provide to you. A couple of reasons for this. Not being thorough, sloppy forms, sloppy documents, not only delays the investment, but can result in additional fees, because some custodians will charge if they have to rework a document because it hasn't been filled out correctly. Those charges can be $50, $75, $100 or more, and these things will add up, as we'll see in a little bit. Respond promptly if your custodian contacts you with a question or request. If they don't get the information they need to file with the IRS, the relationship could end up being strained and could lead into, in the worst case scenario, if you're not cooperating with what the custodian needs to provide to the IRS, they may end up threatening to or actually resigning as custodian, which will leave you in the situation of having to find somebody else pretty quickly, or else have your IRA account distributed to you and have taxes and potentially penalties due because of that. Don't be late in paying your fees. As I just mentioned, custodians will cut you off if you go for a long period of time, and this varies from custodian to custodian. Being late in paying your fees, you don't want to get in that position. And probably last and most importantly is, don't discuss your IRA investment if it's already in place with the custodian that holds the investment. The reason I say this is that a custodian is required, if they learn of a prohibited transaction, they're required to report that to the IRS. So if you expect your custodian to have your back and to be a father confessor, and you think you've committed a prohibited transaction, talk to your attorney, talk to your CPA, talk to your financial advisor, talk to anybody that doesn't have a fiduciary responsibility or a regulatory responsibility to report that to the IRS. So, as I say, for tips for selecting a custodian, confirm that the custodian will hold your investment, and then check the custodian's fee schedule for gotchas. There's a list here. I won't go through all of them, but there are a couple of them here. Extraordinary service fees. Some custodians, if they think that your investment documents are too complicated, they might just come back and charge you $100 or so because they're spending an inordinate amount of time, in their opinion, evaluating your investment documents. As I mentioned earlier, there could be reprocessing fees if documents have to be corrected. One of my favorite is the partial account termination fee, which, you either terminate your account or you don't. And I've never really understood why some of these fee schedules say partial account termination fee. That's just code word for you transferring undirected cash out of your account to another custodian. Keep in mind what I was saying earlier, custodians make money on undirected cash. So if you want to move dividends, interest received from your self-directed IRA investment back over to your Schwab or your Fidelity or your E-Trade account, the custodian is going to charge you a partial account closing fee, or others call it what it really is an outgoing transfer fee. Some of them, if you have to take required minimum distributions, some of them might charge you a fee for taking RMDs. And last but not least, there could be ancillary fees that you don't pay to the custodian, but that you're going to have to pay because of some of their processes and procedures. For example, some of you that might be interested in the so-called checkbook IRA, which is a single member LLC that you invest in. There's, the jury's out in terms of how much these types of investments are embraced. The IRS tends not to like them. There several court cases have confirmed that they're okay to hold in a self-directed IRA account, but some custodians are very much afraid of these. Some won't hold them at all, and others will require that you have an attorney opinion letter, sort of to cover themselves in case there's problems down the road. And that attorney opinion letter can cost $3, $4, $5, $6, maybe up to $1,000 to get in place. All right, so I want to try to go quickly into one of the reasons that I founded SDIC Services was to try to help people wind their way through these various fees when they're out there looking at a custodian. How many of you really have time to go through the fee schedules of 50 custodians? No, you don't. That's why we've done it for you. I have the fee schedules, built them into a database. And let's just see if I can get into the presentation. Are you able to see that on the screen, guys? Aaron, Seth?
I see your custodian fee comparison tool. If
Okay.
you go down to share screen, click that, and it'll give you the option to share whatever box you just opened up.
Let's see, I'm screen sharing.
Click share screen.
Oh, golly. It says I am shared.
And then click, but it'll give you an option to share a different screen.
Oh, all right, all right. Thank you so much. I apologize for this. Let's try that.
There you go. Got it.
All right. So are you seeing here, this is the input form. This is a work in progress. And actually what I'm going to do here is make an offer to all of the attendees here to make use of this tool free of charge so that I can get some feedback and build out additional capability. But essentially we've got here 18 questions to answer. It starts out with your state of residence, your name, email address, your age. You can click on the type of IRA you have. You can click on the type of investment. There's a pick list. As you can see, there's just a world of investment types that you could self-direct your IRA into. Something like what Aaron and Seth offer would be a pooled investment fund. You have the opportunity to select a custodian that you might already be using or are interested in using. And here's our pick list of those 50 plus custodians out there. In this particular case, it was Kingdom Trust Company. They want to invest $125,000. And real quickly, how many investments do you plan to hold in your account? We're looking at the kinds of transactions here that might happen over the holding period of your IRA account. Any non-recourse loans that you might have, we won't get into that here in the presentation, but some custodians charge for non-recourse loans as a separate asset, others do not. Periodic income, is the investment going to throw off dividends, interest, rental income, things like that, into your self-directed IRA account that you may ultimately want to transfer back out? So how many income transactions might there be? How many outgoing transfers might there be to your Schwab's, Fidelity accounts, what have you? Do you expect to pay investment expenses? Do you think you'll keep your account open a short time or a long time? In this particular case, we've got a 5-year account holding period. Capital calls, additional investments that were required here? We're saying probably not. Do you want to take distributions? No, the guy's 50 years old. He doesn't want to take any distributions because he'd be penalized for having done so. Do you need rush delivery service? It's a pick list again, yes or no. And how do you want to pay your fees? Typically, consultants give you the option of paying by credit card, cash held in the account, or by personal check. So we'll just have credit card here. Real quickly, we'll go to the report. What does it look like for this particular example? We're seeing here that over the 5-year holding period, the cheapest custodian would be Alto IRA at $725. Now, this is an all-in cost. This is what you'd pay for the entire 5 years, going all the way down to somebody like Chicago Trust Administration or First Midwest Bank, where you'd be paying $17,000 over that 5-year period for them to hold the account. And you see there's various it's sorted low to high, and you can see where all the other custodians are in this sequence. Keep in mind that Kingdom Trust Company was the custodian of choice that the individual inputted. Their all-in fees would be $5,038. Alto IRA at $725. So you look at the savings between the custodian you're considering, Kingdom, and the cheapest would be $4,313. If you this is just a little example of like, so, how would I price this service? Well, you might say, okay, in return for finding you a lower cost custodian, there might be, traditionally people will have like a finder's fee, let's say maybe a 5% or so. Certainly there are other tools out there. There's a tool out there that you could spend $495 or with a discount of 10%, $450 to allow you to get this same type of information. What we're trying very hard to do is to get this out there for less than $20 a run, just to sort of cover the cost of the the server, the development of the application, updating the data sheets, so on and so forth. And as I said earlier, if you contact me, I will allow you to run this tool free. If you're thinking about making a self-directed IRA investment in the near future, and let's see if I can get back over to the presentation. I want to try to wrap this up because I'll bet you dollars to donuts I've already gone over my 15 minutes. Here's my contact information. Again, my name's Alan Johnson, company's SDIC Services LLC. Here's my email address, and you can reach me by phone at this number, and my cell phone is 201-787-7904. And if I hit stop share, Aaron, does this give the thing back to you?
Yes, I can now share my screen. And what you can do there is if you have a link or you want to maybe put your information, hit the 3 dots. There should be a chat button. Hit the chat. You see at the bottom next to share screen, it says chat. Hit that and then put in your phone number and your email there. So
Okay.
It's right in the chat, and that way people can see it and to contact you. Because Alan, I love that tool. What's crazy is I actually have said, most IRA custodians are pretty much similar priced. I think you've heard me say that at one of my
Yeah.
I on the surface they do appear pretty similar, but with that it's crazy how different they are, and how much money you could save. What was that, $4,000 or $5,000 in price difference? That's wild.
Well, yeah, and it kind of gets back to the challenges that they face. What they're trying to do is they compete with each other out there, but it's kind of like the airline industry. Do you want a pillow? That's $5. You want a soft drink? That's $2.50. They just, again, nickeling and diming, or what you might want to refer to as cafeteria style options. Pay for only what it is that you think you'll use, and for heaven's sake, don't be late. Don't do anything that would cause them to penalize you, because they're certainly motivated to do that given today's competitive environment with the other custodians.
Yeah, no, I love that tool. Amazing tool. Definitely looking forward to working with you more on it and how we can help out my network with that tool as well. So really great stuff. And if anyone has any questions for Alan, feel free to type it in the chat as well. He should be able to see that. And Alan, what I'll do is I'll share the list of signups as well with you. So perhaps you could reach out to them and see if anyone would like that tool as well.
That sounds great. The other thing that we're building out into this is when you get, the entire fee schedule will be presented to you, not just the bar chart. And secondly, what we're going to do is we're working on automating it so that for the top 5 or 6 custodians that you think you might want to consider, we're not going to do it for all 50, but realistically for 3 to 6 of these, we're going to automatically generate an email that basically says, this is what I think I will be doing with my account with you. I think I'm going to have this many transactions. I think I'm going to hold it this many years. I've looked at your fee schedule. This is what I think is going to cost. Would you please send me an email back and verify that this is not a price quote, but verify that I understand what your fees are correctly. Because the last thing I want to do is misrepresent anyone's fee schedules. They're changing all the time. We're keeping the database updated as much as we can. But frankly, as these things change, we want to make sure that the best information is out there so that the IRA account holder can make the best choice for their situation. The last thing I want to throw in here, of course, is price is not always the sole determinant of who you should go with. There are other aspects, and we're starting to work on algorithms that will talk about customer satisfaction, the time it takes for the custodian to get the investment in place. All of these are factors that you would want to consider. But for the time being, part of our consulting services is to talk with people at a very reasonable price and talk with them about their situation and suggest to them some of the custodians that might be more suited for what they want to do than perhaps some of the others.
Yeah, absolutely. It's a really interesting space that a lot of people do not know much about. You used to be a financial advisor, and how many financial advisors probably think you cannot self-direct your IRA? If you explain it to them, they say, no, that's illegal. You can't take your IRA and do,
Right.
go flip a house with it. You can't do that. You can invest in a REIT maybe, but you can't, so it's really incredible. Now this option that you've created, this tool you've created. And I mean, there's so much opportunity out there. What is it? $3 trillion in IRAs. And I think that 1% is self-directed, something like that, right? Or less than 3% is self-directed, I think.
Yeah, the numbers vary. I think they, it might be up to 4 or 5% now. I mean, certainly in the last few years, there's been an awful lot more interest in alternative investments. There's been enough shocks in the stock market. People are looking for things, and real estate is one of the primary investment vehicles out there. It's a physical asset. It's real property. It offers the capability not only to generate income, but to get some capital appreciation as well. And it's a hard asset. I mean, people, especially if they're able to invest locally, they can drive by, they can see the property that they own a portion of. It's very much in vogue right now, and there's a lot of interest in real estate type investments.
Oh, yep. We're seeing that as well. A lot of people are saying, I'm tired of the stock market. I'm tired of my IRA losing 30% in a month, and that's their retirement money. That is what you have to retire on. So if 30% of it can drop out in 2 or 3 weeks, that's a scary idea. I know half it came back, but who knows where it's going tomorrow. So yeah, real estate really is that more tried and true option.
Yeah, that is the thing. I've spoken with people that say, well, all right, I'm going to wait. I'm going to self-direct because it's doing a V, right? It dropped a lot and then it's recovering pretty good, and the market has picked up about half of what it lost. So they're basically sitting there going, well, it's going to come all the way back up, maybe, or it might turn around and drop again. Nobody really knows, and I'm not meaning to suggest this is not a recommendation to do anything other than to just think about the kind of information you're getting from all the pundits out there, and deciding for yourself whether what you're hearing makes sense to you or not.
Sure. Absolutely. Well, thank you, Al. This is a wealth of information. I learned a lot myself with this, and I definitely want to check out this tool when it's ready, when your site is ready. I'd love to check it out myself as well. And this is great. So to our participants, and we see a lot of people have jumped on here, which is great to see that, a lot of interest in self-directing your IRA. Click on the chat where Alan put his information, alan.johnson@sdicservices.com. All right. So you can reach out to him there and he can help you with any questions you have. And what's the timeline you think, Alan, on getting this tool up and running where consumers can use it?
Well, the version that I just showed you, I can make available now. The timeline is to have this in place. Well, it was by the end of May, so I've got like 5 days to get it here. I'll probably miss that deadline a bit. Blame it on COVID-19, right? That's what everybody's blaming everything on.
Sure.
But it's coming along well, and I do expect to have it fully operational in weeks. We're not talking months, we're talking a few weeks.
Great, great, excellent. Okay, I'm looking forward to it. I can't wait. Seth and I are really going to be able to use that tool to help our investors and our new customers coming in. So that's great. All right, Alan, well, thanks a lot. We'll definitely have to have you back for another IRA webinar in the near future. And to our listeners as well, Alan's probably going to come on for a podcast where we're going to talk about UBIT, which is a very in-depth topic. We won't get into it now, but you'll probably see Alan pop up again on the Passive Cash Flow podcast if you want to subscribe on YouTube. And maybe by then we'll have gotten a haircut. We're not sure.
Yeah. All right. Thanks a lot, guys.
Thanks, Alan. All right, everybody. So
Thanks,
stay
Alan.
on. I'm going to jump on over here. I'm going to share my screen. Let's see here. I'm not sure why it's not allowing me. Let's see. All right. Oops. Okay. Seth, is it allowing you to share your screen right now?
Let's see. I think so.
Alan, I'm not sure why. Let me see if I could do this. Technical difficulties here. Let's see. Yeah, for some reason it's saying host disabled participant screen sharing. I'm not sure why it thinks I'm a participant, but I guess it does. All right, Seth, if you're able to possibly share your screen and pull up the presentation, that would be
Let me
great.
see. Yeah, let me give that a shot.
Oh, wait, hang on. I'm going to reclaim host. Here we go. All right, sorry about that. All right. My bad, everybody. We're learning our Zoom here as we go along. So let's get into it. So Seth and I are going to talk about the more real estate end of how to self-direct your IRA into real estate. So Alan just spoke about how to choose the right IRA custodian, which is very important. You can see there's a huge difference in costs and services. And it's important to pick the right IRA custodian, but it's also important to pick the right asset class to invest that IRA into, whether it's a couple asset classes or one of them. We're going to talk about what we do with IRA investors, how we work with self-directed IRAs, and how we bring that capital into the high demand New Jersey market in a way that investors can take advantage of the benefits of owning real estate without having to do all the work or take all the risk of it that Seth and I take on ourselves. So not solicitation for investment. It's not tax advice or legal advice. Quick disclaimer there. Our mission tonight is to transform personal finances and quality life by creating passive income streams through real estate investments. So we aim to create that IRA experience where you can take your IRA and invest it in a company you have trust in, that you're satisfied with, that has transparency and a good asset backing their investments. And we want to bring that opportunity to IRA investors, but in the New Jersey real estate market, where there's a high demand to rent, there's a high demand to, there's a high amount of income in this area as well. We're going to talk about why we invest in this New Jersey market and why we focus on multifamily real estate. So the moment you make passive income and portfolio income a part of your life will change. That's a quote from Robert Kiyosaki, who wrote Rich Dad, Poor Dad. Now, Rich Dad, Poor Dad is a famous real estate book. I'm sure some people in the webinar here have read it. And I read it about 10 years ago or so, and it did change my life and sparked my passion for real estate. So I actually get my real estate license in 2010 and hit the ground running as a real estate agent and teamed up with Seth. And Seth was making such low offers. No other realtors liked working with his offers, but I loved working with Seth because he was buying real estate for great prices and managing it to a T and making great returns. And you make your money when you buy in real estate. So I learned a lot from Seth, and we recognize that his strengths where my weakness is, and vice versa. So I'm more on the investor side, investor relations, marketing, branding, fundraising, educating. And we don't sell coaching or books or CDs. We simply buy mismanaged apartment buildings and manage them better with our real estate management company, so our investors make consistent returns, whether it's a cash investment or an IRA. And Seth is in charge of operations, and he is amazing at it. Seth, you want to talk a little bit about how you got started and what you do? Oh, sorry, I muted you. Let me unmute you real quick. There you go.
Okay. All right. Thank you, Aaron. Yeah, so as Aaron said, I'm more on the operations side of our business, and I've been doing this real estate role for about 10 years with Aaron. And before that, I have a background in healthcare. I'm a couple of years older than Aaron, and for the most part. And so I had a career before Aaron really got started. He was still in college, and that career was in healthcare. I started a business in 2003 with my brother, sold it in 2009, stayed on with the new company for about a year as sort of a consultant. And during that time, I was trying to figure out what I'm going to do with the rest of my life. And I read the same book Aaron read around the same time. He read it, Rich Dad, Poor Dad. And it gave me a whole new perspective on investing and how to spend your time and what passive income really is, assets as well as liabilities, but mostly how to spend your time and what passive income is. And so I've been working since then for the past 10 years, for the most part, 9 of those with Aaron, and building a passive income real estate company that helps people take part in the same thing we're trying to achieve, which is, again, passive income. And quite frankly, passive income is a misnomer, or it's a misunderstood term. A lot of gurus out there talk about it as, well, just buy a 2-family home, or maybe even a single-family home, or almost any kind of real estate. And as long as you're collecting rents, well, voila, you got a passive investment. But that's not really a passive investment. That's an active investment that happens to be real estate. But if you're putting in time, if you're collecting rents, signing leases, dealing with contractors, or anything else related to real estate, if you're putting in any time at all aside from cashing checks and looking at reports, then you're an active an investor. So if you want to be a passive investor and still take part in the benefits of real estate, then you want to work with a syndicated company like People's Capital Group. There's some competitors out there. We happen to be better. We're also local, but you want to work with a syndicated investment company, because they will give you, just like we give you, passive income and still all the benefits of owning real estate, the tax write-offs, and everything else that goes with it. So I've been doing that for the past 9 years. And again, I'm more on the operations side. Aaron's more on the branding and investor relations side. And together we make a great team, and we're growing, and we're looking to educate people along the way and help people take part in passive income through real estate.
Thanks, Seth. All right. So yes, together we've done about 250 transactions. We have an 8-figure portfolio, and we focus on New Jersey, and we're going to explain why we focus on New Jersey apartment buildings tonight. So number one, why do people invest in New Jersey apartment buildings? Number two, why do people prefer a syndicated investment? Now that's when you pool together capital and you share the risk amongst a number of investors, and that allows smaller investors to buy bigger buildings, which are better investments. We'll talk about why that is tonight. Number three, why do people value PCG's service, People's Capital Group? That's Seth and I here, and we own this company 50-50. Seth and I have been working together in real estate 10 years now, flipping houses. We've fixed and flipped over 50 houses. We've wholesaled over 100 contracts, and we also have a house flipping business and a wholesale business. So we also buy apartment buildings as well and have a management company. So let's talk quickly about where the market is. Everyone's curious about how are you buying real estate? How are you investing in real estate with everything going on? And it's tough. You have to be smart right now, right? There's a lot of spaces in the market that we're not bullish on. Single family homes right now, well, those may take a drop in value. Even though the market is actually strong right now, we are seeing that, well, it's getting harder to get a loan. So the harder it is for a single family homeowner to get a loan and buy a home, the less likely those homes are going to trade. So single family home values, we're kind of hitting the brakes right now and waiting for those prices to maybe come down a bit so we can start flipping houses again. That's part of our business. But what we're talking about tonight is the apartment building side of the business. Now, our collections are actually over 90% right now. So our investors are cash flowing nicely on our properties, and getting nice passive cash flow checks on the real estate. And that's because we buy middle of the road multifamily housing. So when people have trouble affording a home and getting qualified for a mortgage, they tend to rent, right? If you can't buy a home, if you can't qualify for a mortgage because banks are tightening their lending restrictions, then more people rent. So right now we're seeing a strong demand for rent and good rent collections, even in these tough times. Other places we like are self-storage. We don't have any right now, but you better bet in tough times, people are going to pay their rent before they pay their storage for their junk. Office and industrial is soft. It's been soft for years. We do not invest there. Retail, storefronts, very soft. Amazon, online shopping has had a big dent in that. And hospitality and senior housing, well, we do like that space, but it's a very different space. It is a growth space, and we see a lot of big corporations, a lot of big industries coming in and kind of pumping up prices in that area. So we actually prefer number 2 here, apartment buildings in this Corona market, and we invest in this high demand North Jersey market. So the cash flow continues to flow in through these tough times, and the rent demand stays strong. All right, so we're going to talk about a strategic way forward here in these tough times, and basically, how to plan strategically to invest in the pandemic so you don't make a bad investment, right? We want to buy properties that are slightly mismanaged and sold at a discount. So Seth and I look for a bit of the ugly duckling on the block. You don't want to buy a $20 bill for $20. You want to pay a discounted price for real estate, and that's what Seth and I do to make sure our investors get the best returns. So always want to educate yourself. What type of market do you want to invest in? Work with experienced investors who have more experience than you in that asset class, who have made their mistakes, have invested in that market before, and also take into consideration when you're investing in any syndication or any type of asset class, your degree of the value of play as far as how much risk you're looking to take on, how much risk you're comfortable with. Location, do you want to invest maybe in a piece of real estate that is near you within an hour or so of where you live that you could drive out to, or is that not something that's important to you? Of course, you don't have to manage it, but as Alan was saying, a lot of people like taking their IRA and putting it into, say, Newark, New Jersey, or Paterson, New Jersey. These are inner city areas, and I grew up in North Jersey, and I grew up 20 minutes from Newark, New Jersey, and in Millington, and it is crazy the income disparity between Newark and 20 minutes away, or Livingston, and Basking Ridge. It's crazy. So investing in these inner city areas and trying to improve these inner city areas as we take mismanaged properties and make them better. A lot of people like that, and also the history of the market. Right? Is the market overpriced? Like Hoboken right now, we see Hoboken, New Jersey is kind of an overpriced market for many years. Okay, maybe price will come down a bit there. It's not really much indication of that, but you want to buy in markets where that's not overpriced. And we feel like Hoboken, even parts of Jersey City, if you know New Jersey, those are kind of overpriced markets. So we look more for the underpriced markets in inner city areas in North Jersey. It gets you to Manhattan in less than an hour. So some other parts about New Jersey, some other facts about New Jersey, the reasons we like it here. The wages have rose here in 2019. Wages are strong. Rents are strong as well. We know there's obviously a pandemic going on, so we're curious to see where these numbers lie by the end of this year. But we're in a high demand market here in North Jersey. Okay, a lot of education, number 1 in education, number 3 medium household income. So that's great for our investors because that means that our buildings are rented. Even when there's a recession or a tough time, like I was saying, even in this wacky time right now, we're at 90% collections for most of our large buildings. And that's a testament to just the strength of this market and the strength of our management company as well. The state is home to 20 Fortune 500 companies, number 1 in drugs and pharmaceuticals, number 2 in direct foreign investments. So a lot of capital coming into New Jersey, a lot of capital earned here, and a lot of people living in one place that generally need to commute in or around Manhattan. So North Jersey holds that demand. So why do people invest in New Jersey apartment buildings? So we found that people want legal tax shelters and predictable investments. Okay, real estate's a little more predictable than the stock market. We can control the asset for the most part. We can control who's renting the units. What the rents are for the units for the most part. Okay, we can control the way the area smells and looks. Okay, the building, the common areas. Okay, the exterior of the building. We can control the environment of the building there so that it's a safe place to live, where people are going to pay more rent to live there. So this allows investors to confidently invest with their IRA or 401k, and Alan can talk to you more about working with your 401k and you turning it into an IRA to self-directed and how that works. That's not really our specialty, Alan. That's Alan's specialty. But essentially, people are looking for low risk investments. So by investing in a larger building and putting in a small investment to get a piece of a large building, it's much safer than owning, say, 100% of a two-family, where if you lose one tenant on a two-family, you lose half your rental income. And that means you're probably writing a check to cover the costs every month. And that's not where you want to be. So larger buildings, say a 25, 50 unit building, if you lose a few tenants there, you're still going to be able to actually cash flow every month, and we'll be able to cover all of our costs, where smaller buildings are higher risk because they have less tenants paying in. Think of it like a business. If you have 25 or 50 customers paying you, that's a stronger business than 2 or 3 customers paying you. So people want to invest in ideal New Jersey properties with easy New York City commutes that meet New Jersey housing demand. So again, there's a lot of demand to live in the small place in North Jersey. People want these high demand properties that produce more predictable returns with cash flow and refinance cash outs. We'll talk about that in a little bit. So by managing the apartments with our management company, that allows the buildings to actually produce better results. Okay, so by having our management company in-house, it kind of gives us a competitive edge over a lot of other syndicators who are buying out of state and hiring outside management companies and hoping for the best. So by working with our own management company in-house here in Berkeley Heights, New Jersey, our properties produce better returns even through recessions, as we've seen now. Okay, so by producing more predictable returns, stronger long-term returns, our investors are able to fund important occasions in life, like putting their kids through college, weddings, and of course, travel. Okay, we long for the days. Oh, look at this happy family getting on a flight. Don't worry, my friends. Those days will come again. And that's what our investors like to enjoy, because we do all the work while they get to take the benefits of the real estate ownership without running around doing all the work that Seth and I do. So as we were saying, by spreading out the investment over many units, you have more tenants paying you, so the vacancies hinder your income less, so the buildings produce better incomes. Bigger buildings are safer investments. Normally, a small investor couldn't get into a big building, but we pool the capital so you can get into these big buildings in high demand markets. Secondly, we're going to personally guarantee the mortgage. Seth and I will personally guarantee a mortgage so that our investors don't have to. Now, if you talk to Alan about using your IRA to buy real estate and you start talking about personally guaranteeing mortgage and guarantees on mortgages, you'll quickly find out IRAs cannot guarantee a mortgage. So what Seth and I do is we structure our operating agreement, we structure these acquisitions so that we personally guarantee the mortgage and the investors are not on the hook to cover the mortgage. They do not personally guarantee it. That way, Seth and I, we make sure the building performs, but also that allows our investors to take a ton of risk off their shoulders, puts it on our shoulders, and it does allow investors with IRAs then to come through, self-directed IRAs, to work with our syndication. So ideal New Jersey apartment buildings with easy work and entertainment commutes to New York City is what we focus on. Okay, Newark, New Jersey gets you into Manhattan now in less than an hour, same with Patterson, but those rents are way below other rents in other cities that give you similar commute times. So we see a lot of opportunity there, and we've done very well in those cities for many years. We still do. So Newark and Passaic, New Jersey constantly remind investors about the millennial rental demand. Well-managed New York City properties, New York City access properties, really light up their world. So people are living outside the cities a lot more. They're kind of moving into the cities surrounding the main cities and commuting in, or just really trying to get out of that high-priced Manhattan and even the boroughs of Manhattan. We do not focus on that. Brooklyn, Bronx, those areas are so overpriced. And we see a lot of people migrating over to New Jersey, where you can get a much more affordable apartment, and they really want to live, and they don't mind living in downtown Newark or downtown Patterson, these inner city areas, when you give a nice quality of living, a safe environment. And we do find that tends to be a line out the door to lease our vacant units, which is great for our investors. So number two, why do people prefer syndicated investing? Well, as we were saying, simply people don't want to manage the property. Right? Real estate's a very management intensive asset. It is not an asset you can sit back and watch the cash flow come in. There's a ton of operations. Even if you hire a management company, it's a lot of work. So our investors prefer quarterly passive income check in the mail, a nice quarterly financials, very detailed updates every month. And by syndicating the investment, we shift the risk amongst many investors. So individuals like the idea of kind of tapping into our real estate knowledge and expert experience here in New Jersey, with Seth and I both investing in this market for 10 years each and working with our management company we've developed here, that lifts up our investors above the pitfalls so that they can break into this market without having to do the years and years of research Seth and I have done, and the years of relationships to find these opportunities, which we'll talk about tonight, how we find them, how we analyze them. And so people really value their free time and have no interest in securing that complex financing that it takes to buy these properties or all the complexities of managing it. So real estate is a little complex as far as structuring it, managing it, and syndicating it, but it's not that complex how the investors earn returns with the cash flow and tax benefits and the refinance cash outs. But the nitty gritty of it in the day-to-day is tough. So Seth and I take care of that from A to Z, and that's what a syndicate investment is. It's a hands-off investment. So we buy the property for a discounted price. We get the property to perform better by lowering our expenses and increasing our forms of income, renegotiating leases for top rent dollars, finding out more ways to make income on the property. We're working with our tenants also to make them happy and make sure that they're understanding the rent's going to go up to a fair price, but they're going to also get something in return for that, such as updates their apartment and a better quality of life and a better management company. Our CPA we work with a whole third-party CPA and accounting bookkeeping firm that does all the bookkeeping and accounting, so our investors can get nice, clean, professional tax documents at the end of the year, make that very easy tax time for our investors. And every 3 to 5 years, we have an exit strategy with a cash-out refinance, where our investors have two options to exit the investment or stay in, which Seth will talk a little bit about in a minute. And so we'll invest up to $10,000 a month to find these deals. We'll look at over 400 properties sometimes in a month to find one opportunity for our investors. And we try to bring a syndication to our investors every 3 to 4 months. It's very hard to find a good deal in North Jersey. It's a very high demand market, but we're able to usually bring our investors a good opportunity, a discounted apartment building with a value add opportunity every 3 to 4 months where they can make those solid, consistent returns. We have about 10,000 real estate professionals in our network and investors, and about 3,500 members in our meetup group. Maybe that's where you found us online. We do 3 webinars a month. We have a YouTube channel called People's Capital Group, and I do the Passive Cash Flow podcast, which is released every Friday. So we give our investors a lot of content, a lot of continued education. And we've done over 250 properties together, over 40 million transactions. We have about 75 units right now. Sold about 40 over the last couple of years, about $10 million in holdings. And we personally guarantee that mortgage. So we're hyper motivated to make sure we hit those marks when we're going for our reposition and improving the value of the property. And I'm going to have Seth here talk a little bit about our aggressive calculating model here and why people value our service at PCG.
All right. Thank you, Aaron. All right. Well, people like our approach to buying real estate and how we manage the real estate. It's very aggressive. It's calculating. We spend a lot of time, a lot of hours behind the scenes. So while our investors are out taking time off from work or home with their family or away on the weekends, or quite frankly, retired, we're out there working. We're working aggressively. We're working smartly. We're diligent, and we're making things happen, and we're creating value. So we like to tell our investors while they're sleeping or while they're on vacation, we're out there, we're doing the work for them, and their money's backed by, again, all the benefits of owning real estate. It's very secure when you invest in real estate. Now, this also includes a professional approach to how we handle everything from A to Z. So the process of owning real estate, from negotiating to actually, again, managing it, dealing with tenants, earning their respect, making sure they pay on time, getting a high collection rate, and setting a high bar with our tenants and our investors and our relationships with banks and everybody that we work with. So just setting a good example. This slide is about how we find our deals. So we spend a lot of money as well as time finding deals, negotiating deals, and we cherry pick the best ones. We share them with our investors. So again, our investors don't have to go out looking for deals. Again, as Aaron said, it takes a lot of time. Deals are hard to come by in the New York City metropolitan market, and for the most part, you have to make your deals. You have to negotiate them. You have to create them, and that's what we do. So we take the best ones, we keep them, we sell the least attractive ones. But for the most part, for the most part, 1 out of 100 deals might be good. So there's a lot of bad deals out there, and we kind of filter through them. We look at about 400 properties a month. Sometimes it's more, sometimes it's less, but every day Aaron and I are going through properties in our inbox, talking to realtors, talking to sellers, and a lot of other people in the real estate business looking for deals. And quite frankly, a lot of people give us deals because they know we can close quickly, and we stick to our word. Now, syndicating involves pulling money together for great returns. Risk is shifted to us, as Aaron had mentioned as well. There's a lot of advantages to owning a 25 or 50 unit building as opposed to a 2-family or a 3-family. Just because if you have 1 vacancy in a 2 or 3 family, you're losing a third of your income or maybe half of your income. If you're losing a tenant in a single family home, same thing, you're losing all of a sudden all your income. However, if you have a 50-unit building or a 25-unit building, and of course, if you lose 1 tenant, obviously it's not as impactful. Okay, so if we go to the next slide here, if you can, thank you very much. Okay, so increase in net cash flow. So the overall goal here is to increase the value of the property, and the people we work with, the investors we work with, they like how we handle this process. It takes a lot of experience and knowledge on how to increase the rents, how to decrease the expenses, and that's the way you increase the value of real estate. But real estate goes up 2 different ways. All real estate with a structure on it will go up in value if it's maintained, if the condition is maintained. But it can go up in a forced way. We call it forced equity, if you increase the rents and decrease the expenses, thereby increasing the net operating income. And that's one of the skills we bring to the table. And we do that by understanding the laws in each municipality, whether it's rent control, the code, making sure we have the right leases, and getting the top dollar for the rents, also separating out utilities. A lot of the properties we buy, the landlords are mismanaging the utilities. They're paying for a lot of the heat, and even in some cases the electricity. They're uncomfortable asking their tenants, some of whom have been there a long time, to pay the utilities as the leases come due, but they have that option in many cases, but they choose not to do it. So what we'll do is we'll, in most cases, change out the utilities so that the tenants are paying as leases come due and new tenants move in, and thereby increasing the net operating income. So we're not just increasing the rents every year, but we're also decreasing the expenses. Ultimately, it's all about the return on investment. And when we do this year over year, we typically refinance in year 4 and 5, and our investors receive a large capital distribution from the refinance, which is tax-free. So they like that very much. And of course, they also take advantage of the cash flows every quarter and the tax depreciation. Okay, next slide. So we have been bringing years of experience and expertise to each real estate investment that we've worked on through the years. People like the fact that we know how to maximize an investment. We know how to increase, as I said, the value of the property, and just knowing how to manage the property is critical. And it, quite frankly, does take a lot of years to perfect, something that a lot of our investors have little interest in trying to learn, or quite frankly, little time to learn. So they like the idea of leveraging our abilities, our time with their money. It's a win-win situation, and they can take part, again, in all the benefits of the real estate without having to do the work. Another important thing that we do is we only manage our own properties. We have a 96% collection rate in the last couple of years, and we don't take on other properties. Some people do come to us from time to time asking if we'll manage their property. We decline it respectfully because we don't want any distractions for our assets, and we want to be able to tell our investors that we are 100% committed and focused on their investments together with us, and there's no distractions. Another important thing is construction. We come into each asset that we buy with a clear understanding of what construction might be needed, not just immediately, but over 5 years. And we try to escrow those funds. We calculate the construction based on our experience. Our investors like that. We also work with contractors that we have built a relationship with for many years, in some cases 5, 6 years. Contractors, like any profession, are hard to find, good, reliable, with integrity. And so we bring those to each investment. Our investors like that as well. Consistent cash flow is the name of the game. That's the ultimate goal, doing it legally and ethically, creating value, cash flow, passive income streams with an exit strategy for our investors. And let's now come to the exit strategy. So after years 3, 4, or 5, typically, we will notify our investors that we're coming to the point of refinancing the property. And this is, again, where we create a large capital distribution and all of the investors take part in it. It's tax-free. And at that point, the investors have the opportunity and the decision to whether they want to stay in for another 3 to 5 years or they want to take their profits and their principal and exit. It's their choice. Okay. Now, we have worked with dozens of investors over the years, past 7 to 8 years, and we're at the point now of adding new investors as we reach a new stage of growth. A lot of our investors, as Aaron has said, have invested numerous times, in some cases 5 or 10 times. And at this point, we want to reach out to even more investors. We still work with the old investors, but we are looking to grow and bring people along with us to take part in that growth together. And the qualifications are something we're going to talk about a little later. Aaron, I'm going to hand it back to you, and you can take it from there.
Great. Thank you, Seth. Absolutely. So yeah, we have a nice collection of 30 investors, about 20 more in the queue lined up for our next acquisition. I'm going to quickly talk about 2 case studies and then we'll let everyone go for the night. So here's a small building we bought in Newark, actually downtown Newark, around the Rutgers area, really a university area there in Newark. And they were asking $130,000 for it. And we bought the property for $110,000. So our job is to negotiate a good price off the bat. Normally, we try to get 10 to 20% off the fair market value of the price, right? You never want to pay $20 for a $20 bill. That's why people come to Seth and I to invest, because we can find discounted opportunities in this high demand market. So we captured $20,000 equity off the bat, put $30,000 in renovations into it. It appraised for $310,000 a year later. So we were able to refinance, pay back all the money we were into it for. Our investor got paid back 100% within a year, plus more additional cash to the refinance. Now the cash at refinance is tax-free cash because that is debt. It is not income. We're not selling the building. As long as you're not exiting the investment, that cash from the refinance, that capital distribution of the refinance is income tax-free. So of course, if you're using your IRA, there are tax advantages to that. And we plan on doing a 1031 tax deferment, which is our final exit strategy. But our strategy with real estate, the buy, renovate, refinance strategy, is a great tax strategy, because when you get the majority of your returns through the refinance strategy, which is exactly how our investors get the majority of their returns, about 2/3, it's tax-free. So if 2/3 of your returns are tax advantage or tax-free with this strategy, I know we're talking about IRAs tonight. It's a little more complex. They're all tax advantaged. But in this case, the buy, renovate, refinance strategy is really a great strategy for any investor, especially our cash investors who normally get hit taxes, because it's income tax-free money at the refinance. So we could talk more about that if you're a qualified investor and answer your questions as well. But in this case, we actually refinanced again in 2017, split up another lump sum of cash, and the investor continues to cash flow on the property, continues to get tax depreciation, and collected a lump sum capital distribution twice from 2 refinances on the property. And that's just how real estate can be the gift that keeps on giving with the buy, renovate, refinance strategy. You know, why sell something that's making you cash flow every quarter, right? Seth and I never understood that. Hold on to the real estate. It's well managed, it's cash flowing, tons of tax benefits. So here's another example of a 25 unit we bought in Paulsboro, New Jersey, South Jersey. And we recognize that the South Jersey market is a lot harder than the North Jersey market. So that's one of the reasons we sold the property. But we did very well on it. We bought it in 2014. We sold it in 2017. We owned it for about 2.5 years. And we paid $1,075,000 for it. And we captured about $125,000 in equity right off the bat. So we got a nice discount right off the bat. Seth and I got a bank loan for 75% of the purchase price at a 4.5% interest rate. And we had 4 investors come in with $100,000 each. It's not always that clean. Sometimes we have a $30,000 investor, then we have a $250,000 investor. So it's always a little different on each syndication. Of course, the more you invest, the larger the share you owe. And in this case, we did a 60-40 split with our investors owning 60%, PCG owning 40%. And we sold the building in 2017 for $1.35 million. And our investors made about 11% cash on cash return annualized on that building roughly. And they were able to make a nice solid double-digit cash on cash return where we projected about a 9.5 and we hit right around an 11. So we were able to under promise and over deliver, which is always our goal when we're investing with passive investors and buying real estate here in New Jersey. Okay, our job is to get a great price on it, but also when we analyze a building to be really, really conservative. And there's tons of ways we're extremely conservative with our estimations, with our projections and our analysis of buildings. I won't break into it, but essentially we really, really try to assume the worst and hope for the best. So when we're buying a building, we make a very conservative projection on the numbers, and that allows us to buy buildings at very discounted prices when we finally find that motivated seller. Let's talk about self-directing your IRA here. Alan was able to talk about this in more depth, so I'm going to breeze through it a little bit, but essentially by working with Alan, you can find the right IRA custodian that meets your needs. You do have to select an IRA custodian, and then that IRA custodian is going to essentially contact whoever's holding your IRA right now. They're going to have them move that IRA over to the custodian once you hire that custodian, of course, and fill out the proper paperwork and get them started. What's the startup cost? Well, Alan can help you with that. And so once you hire that custodian, then they're going to move the money over to that custodian, and then you can decide the right movement for that money. Now, remember, there are rules and regulations on what you can do with your IRA. At that point, there are IRA custodians that allow you to start an LLC that is owned by your IRA and managed by you, called a checkbook IRA LLC, which is another step that you really don't even have to take. Especially if you're investing in a company like ours, People's Capital Group, it's really quite simple. You just take your IRA, you select the right IRA custodian. They're going to reach out to whoever holds your IRA now. They're going to move it over to the IRA custodian, and then the IRA custodian is going to review the operating agreement of our private offering. They're going to have you sign off on it, or they're going to sign off on it, however they have run the operation of the signing the operating agreement. And then essentially transfer the IRA to the title company to close on the real estate, and the IRA will own part of that LLC. Now, it's a quite simple process of self-directing your IRA to the custodian and then to the title company to close on the real estate. The real estate is purchased, and then the LLC we create that the IRA owns a part of is going to produce cash flow checks back to the custodian, and it's going to grow your IRA, and those cash flow checks are going to go to your custodian every quarter. And then a large capital distribution is going to go to your IRA custodian upon the refinance. And that allows the investors to really build their IRA much faster and much more aggressively than it would be perhaps riding index funds going up and down with the stock market. So by working with an IRA custodian, you do have to work with one. You have to select one, pick the right one for you, but then you can just self-direct your IRA into that custodian and then move it into an asset, perhaps with People's Capital Group or any type of asset that's qualified, and your IRA custodian will guide you more on that so you can start protecting your IRA a little bit more and also getting better returns with that IRA through cash flowing real estate that's professionally managed in a high demand market. I just want to go over 3 types of investors we normally work with, and then we're done here for the evening. So essentially, we work with high income investors, accredited investors that earn $200,000 individually, or $300,000 with their spouse, or they have a net income over $1 million. That's an accredited investor. We also work with non-accredited investors as well, which I'll go over in a second. But accredited investors are high earners. They tend to have large stock portfolios. Real estate offers cash flow, which is similar to stock, similar to dividends, but cash flow can be written off with tax depreciation where dividends cannot. So we're talking about IRAs tonight. So taxes are a bit of a moot point. If done properly, you're going to essentially be tax deferred for all your taxes and tax advantaged for all of it. But essentially, at the end of the day, by working with real estate, there's a ton of tax benefits. So you can write off the cash flow on the real estate, whether you're investing with an IRA or a regular cash investment. Also, we believe real estate, especially in high demand North Jersey markets, professionally managed, is more recession resilient than the stock market, which we've seen goes ups and downs with the volatility of the market and the media headlines. So active real estate investors also get tired of managing their properties and personally guaranteeing the mortgage, and they recognize if they actually invest in larger properties with us and don't have to do any of the management, they make the same, if not better, returns than owning 2s and 3s and 4s, running around managing it, personally guaranteeing the loan, and being an active real estate investor. So a lot of those guys and gals we sell properties to that are fixer-uppers, that are running their own show, actually end up investing with us passively because we can earn the same returns roughly for them that they were earning managing their own real estate and being on the hook for the mortgage. So obviously it's a better setup to be passively invested with People's Capital Group, not have to worry about filing the taxes or buying only small properties, to get into bigger properties, earn better returns, and be into safer investments that are professionally managed. So active real estate investors will actually invest passively with People's Capital Group. Third type of investor we work with is, of course, IRA investors. That's who's mostly on this webinar tonight. Thanks so much for joining us. We had a great turnout. And so we had IRA investors. About a third of our investors self-direct their IRA into real estate with us here, People's Capital Group, and break into this North Jersey market. That allows them to get those long-term, more predictable returns. And also, like we were saying, be more recession resilient. So consistently earn that cash flow, whether times are good or times are bad, whether we're in an up market or a down market, consistently be able to get large capital distributions upon the refinance. And that's something that the stock market can't always offer. And on top of that, people really like putting their IRA into inner city areas and improving those inner city areas with their IRA. And that's something you just don't get out of buying an index fund. So a couple financial transformations here. We worked with over 30 investors. We have 20 investors in queue. Most of our investors reinvest time and time again, because once you start earning good returns of People's Capital Group and recognize that we underpromise and overdeliver, that really it's a safe place to continue to invest long-term, whether you're working with an IRA or a cash investment. So we work with sophisticated or accredited investors. If you want to figure out if you qualify for an investment with People's Capital Group, click the link in the chat. I put a link in the chat that goes to our website where you can qualify to invest. You can fill out the qualification form. Hopefully you do qualify to invest with us. If you're an accredited investor, meaning you earn $200,000 or $300,000 with your spouse, and or you have a net worth of $1 million, not including your primary residence, then you are an accredited investor and you most likely would qualify to invest with People's Capital Group. If you're not an accredited investor, you don't make that financial cut, but you understand the asset class, you have some experience in real estate and real estate investing, and you have a minimum investment of $50,000, then you would likely qualify as a sophisticated investor. So if you're not sure if you're a sophisticated investor or an accredited investor or neither, the first step is going and clicking on that link in the chat. Here I put up, click the 3 buttons on your tab that pops up and click chat. And you'll see in the chat, I posted a link that you can go to called People's Capital Group /qualify to invest. So click that link now, fill out the form to see if you qualify to invest here for a passive investment with People's Capital Group. Hopefully you do, and hopefully we can send you our most recent private offering, which we're about to send out to our qualified investors towards the end of this week. So we do have a new private offering. We're going to be sending this private offering out to only qualified investors. If you don't fill out the form and you're not qualified, you're not going to see this offering. It's not something we put all over the internet. There's rules against that. It's a private offering. So the first step to even looking at the private offering and reviewing that is to fill out the qualification form and get qualified. We make it very easy to do. You can do it right online. So go ahead to the chat, click that link. I will leave this screen up for a little bit of time here, so you can go ahead and click that link and fill out the qualification form. But that's it for now. Looks like we don't have any questions here in the Q&A, which is great. That means Alan and Seth and I did a good job answering everyone's questions. If you'd like to contact Alan, his information is also in the chat. I'm going to leave this up for a few more minutes, but that's it for now. Everyone enjoy their evening. Just flatten that curve. Keep doing what we're doing. We're doing something right. And soon, Al and I will be able to get our hair cut, and that's going to feel really good. It's going to feel really good. So we're looking forward to that. Thanks a lot for attending, and let us know if you have any questions. Enjoy your night.